Seriously, we often imagine the engine of human progress as a linear progression of genius, the lone inventor in a garage, the scientist at the chalkboard. But modern innovation is fueled by a far more volatile and calculated substance, venture capital. It is the Darwinian engine of the global economy, a high-stakes ecosystem governed not by the simple laws of commerce, but by the complex dynamics of game theory, biological signaling, and the brutal mathematics of the power law.
Today, we peel back the polished veneer of Sand Hill Road to analyze how this machine actually functions and why it rewards a very specific set of traits while discarding everything else. To understand the VC of today, we must look back to the 19th century whaling industry in New Bedford, Massachusetts. This was the first true venture model. Investors would fund a voyage, a high-risk, high-reward expedition into the unknown. If the ship sank, the capital was lost. But if it returned with a hull full of spermaceti oil, the returns were astronomical. Seriously, this agent-principal relationship established the blueprint: limited liability for the financiers, and a carried interest for the captain. In the 1950s, this model was formalized by Georges Doriot and the founders of Fairchild Semiconductor, shifting the focus from whale oil to silicon. Urgent, the core mechanic remains, the power law. In a standard private equity or mutual fund, a 20% return is a triumph. In venture capital, 20% is a failure. VC is built on the statistical reality that out of 10 investments, 6 will go to zero, 3 will break even, and 1, the black swan, will return the entire fund 10 or 100 times over. This creates a specific set of incentives. VCs are not looking for good businesses. They are looking for outliers with the potential for infinite scalability.
This brings us to the term sheet, the DNA of the startup world. While headlines focus on valuation, the real game is played in the fine print. Clauses like liquidation preferences ensure that investors get their money back first, often with a multiple, before founders see a cent. Anti-dilution provisions protect investors if the company's value drops, while drag-along rights can force a founder to sell their life's work against their will. It is a sophisticated system of risk mitigation, designed to ensure that even in a mediocre outcome, the house, the VC, wins. Why does the system favor certain people? This is where social biology and game theory intersect. VCs often rely on pattern matching. Because the future is inherently unpredictable, the human brain seeks shortcuts. This leads to a preference for founders who exhibit high agency traits and specific social signals, often graduates of elite institutions or former employees of successful unicorns. It is a manifestation of homophily, the tendency for individuals to associate with others who are similar. Biologically, the VC-founder relationship is one of signaling. The founder must signal dominance and conviction to trigger the investor's fear of missing out, or FOMO. This is a classic prisoner's dilemma. If one VC passes on a deal, they risk missing the next Google. If they all pile in, they drive the price up to irrational levels. Urgent. This musical chairs dynamic is most evident in blitzscaling, a strategy where companies prioritize rapid growth over profitability to capture a market. It is a race to achieve a natural monopoly. But this comes at a cost. By flooding a startup with capital, VCs often force the company to outgrow its infrastructure, leading to the spectacular collapses we see in the zombie unicorns of the late 2020s. We must also consider the role of the limited partners, the pension funds, endowments, and sovereign wealth funds that provide the dry powder. They are seeking alpha in a low-yield world. This pressure trickles down to the general partners, who must deploy capital within a fixed 10-year fund lifecycle. This creates an artificial urgency. Seriously, the Darwinian engine is not a meritocracy of ideas. It is a filter for scalability and exitability.
It has given us the internet, biotechnology, and space exploration, but it has also created an environment where growth at all costs can stifle sustainable, long-term value. As we look toward the next frontier of AI and quantum computing, we must ask, is the Darwinian engine still the best way to fund our future, or are we simply trapped in a game where the rules are written by those who already own the board?